Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets hidden within the financial statements. Sometimes you read these reports and it feels like you need a translator and maybe a detective. Well, today we're doing both. We're diving into the latest annual report from Azenta, Incorporated, a company that wants to help speed up getting important medical treatments to people. Let's see if their own business is running as smoothly as they hope their customers' therapies will get to market. So Azenta is telling us their sales went up just a bit, around 4% in their most recent fiscal year. That is after they had a similar small increase the year before. It is not exactly a rocket ship taking off, but it is growth, and it is coming from both halves of their life science business, which they call sample management solutions and multiomics. The sample management side is all about taking care of biological samples, like in automated stores and cryogenic systems, basically keeping things super cold and organized. The multiomics part is more about the sciencey stuff, like gene sequencing and synthesis. Overall, they brought in nearly $600 million in sales. Not too shabby, but let's zoom in. While their revenue is inching up, their operating expenses are also pretty high. For example, their selling, general, and administrative costs stayed pretty much flat year over year, hovering around $260 million. That means a big chunk of their earnings goes right back into running the business. And that brings us to the bottom line. Azenta is still in the red when it comes to their regular operations. They reported an operating loss of about $27 million. This is actually better than the previous year when their operating loss was closer to $51 million. So that is a good sign, but red ink is still red ink. Now, this is where it gets a little confusing. After all the numbers are crunched, they're reporting an income from continuing operations of about $24 million. How does that happen when they had an operating loss? Well, it is largely thanks to a huge income tax benefit of over $31 million. This benefit came from something called a worthless stock deduction relating to an investment in one of their foreign subsidiaries. Basically, they got a big tax break because an investment essentially became worthless. It is a bit like finding a massive tax refund, which is great for the bottom line, but it is not directly from selling more products or fixing their core operating losses. It is important to understand that this tax gain masked the underlying operating deficit. Then there are the discontinued operations. This is the stuff they are selling off or have already sold. Right now, it is mainly their B Medical Systems business. This part lost them over $80 million in the most recent year, largely due to an estimated loss on selling those assets. This continued loss from discontinued operations is a drag on their overall net results, contributing to a total net loss for the year of nearly $56 million. They are actively trying to simplify by selling off parts of the business that don't fit their core strategy of helping life science companies. This B Medical Systems piece, which makes refrigeration devices, has been classified as held for sale. Now let's talk risks. Azenta is facing a lot of challenges, as most growing companies do. They're worried about economic downturns, inflation, and global events disrupting their business. They also mentioned cybersecurity threats, which is a big deal for any company handling sensitive data, especially in the life sciences field. Here is a red flag. Their own auditors pointed out that Azenta has material weaknesses in their internal financial controls. This means there are significant problems with how they track and report their own finances. Specifically, there are issues with reviewing their cash flow statements, preparing account reconciliations, and classifying certain costs. This is a serious concern because it can lead to errors in financial reporting which can hurt investor confidence. They are working to fix these, but it is not a quick process. They also flag the risk of goodwill and intangible assets becoming impaired. Goodwill is basically the excess amount they paid for acquired companies over the fair value of those companies' identifiable net assets. If those acquisitions don't perform as expected, they might have to write down the value of this goodwill, which hits their earnings. They're carrying over $700 million in goodwill, so any impairment here could be significant. Look amortization of completed technology scroll on the financial tables. We see some interesting numbers, for instance, their sample management solutions segment, which is their bigger segment in terms of revenue, saw its gross margin improve. That is good. But in the multiomics segment, the gross margin actually went down a bit last year. Overall company gross margin stands at about 45.5%, which is pretty solid. But if you dig deeper, the story gets more nuanced. While the sample management solutions segment showed improved margins, largely due to better sales mix and cost management, the multiomics segment faced some pressure. So what is our take on Azenta Incorporated? They are clearly playing in a critical and growing sector, the life sciences, with solutions that can genuinely help bring therapies to market faster. Their strategy of expanding through acquisition seems to be bringing in some revenue, but the profit picture is still murky. The operating losses and the reliance on a significant tax benefit to show an income from continuing operations are concerns. The material weaknesses in internal controls are a definite red flag that management needs to address urgently. On the bright side, they are generating more cash from operations. And they have a healthy amount of cash and marketable securities on hand. The divestment of non-core assets like B Medical Systems is a smart move to focus on their core strengths. However, the company faces significant risks from market volatility, competition, and the ongoing need to innovate in a fast-paced industry. Moving forward, the key will be their ability to consistently turn their revenue growth into actual profits, improve their internal controls, and successfully integrate their past and future acquisitions while navigating a complex regulatory and economic landscape. Their direction seems to be focused on simplifying and executing, but the path to sustained profitability still has a few hurdles. Alright, that is our breakdown of Azenta's latest report. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description to join the conversation. Thanks for watching, see you next time.